This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages. Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Well, today we're going to take a look at how the war in Ukraine is affecting LNG shipping rates.
Plus, the verdict on Tesla and its ESG credentials.
But first, let's take a look at emerging market investment opportunities, specifically when it comes to Latin America, particularly when there's lots of election question marks when it comes to Colombia or Brazil, etc. So to do that, we're joined by Bloomberg Intelligence equity strategist Gaurav Patankar. Gaurav, thank you for joining us.
Thank you. Great to be here.
Okay, so first of all, the overall thesis, we have high inflation, high commodities, high dollar, high rates. What does that all mean for Latin America?
Yeah, typically the simple answer would be that it may not be all that good, but we actually think it's a great situation for Latin America. Latin America has traditionally been underowned by emerging market pools of money, i.e. emerging market asset managers. That is just about changing. Valuations are undemanding. There's a lot of traction in the commodities complex, and that's really percolating into the real economy. So we really are seeing some capital spending, a reasonably good understanding of politics, but that's already in the price. And we are seeing a good capex cycle playing out in some of these markets. So Brazil and Mexico are two of our favorite markets in Latin America right now.
All right, but if I'm emerging markets, I can't really go to China. I can't really go to Russia. I kind of have to go to Latin America. Are we seeing just some of that rotation maybe of funds?
That's a great question, Paul. There are 26 countries, and even in normal circumstances, it's a challenge given 26 different macro trajectories. Now, there are many places, as you correctly point out, that are no-goes. But I think there are three pockets of alpha as we see it. Latin America certainly is a bright spot that we've been talking about. Of course, it has had a decent year this year, but if you look at it from over the last 1, 3, 5, or even since the global financial crisis, I think you'll be surprised if I say that Latin America as a whole is down 40% in dollar terms since the global financial crisis, while the NASDAQ is, up somewhat 400%. ASEAN and India are the two other pockets within emerging markets that we really like.
Staying in Latin America for a moment, would the bet in equities be commodity-related equities because we are seeing such a bull market in certain commodities, or is it going to be consumer-related?
Alix, anything in Latin America can never be completely detached from commodities, but I look at commodities and our research shows that it's almost like an ignition point. So commodities have to light the fire, which I think they have in a way, and that ultimately percolates into the real economy. I think the story from here on is going to be about the Latin American consumer showing up. We are already beginning to see some signs of that, but clearly you cannot detach itself from commodities. So if commodities were to plunge tomorrow, which is not our central case, but that's never going to be good for Latin America. But for now, in the next 12 to 18 months, we see the consumer really showing up.
All right, well, on that commodities call, all I think about in my brain is oil, but I know there's more than that. How do you think about the commodities call as it relates to Latin America?
Yeah, I wouldn't profess to be an expert in commodities, but I'll say this. Latin America is blessed with both soft and hard commodities. Clearly, with all the issues with food supply and food security, Latin America, firstly, given its geographical proximity to the U.S. And other consuming countries, as well as the abundance of soft commodities in the arable land, I think is extremely well positioned there, as well as hard commodities, especially when it relates to metals and some of the rare earths. So I think Latin America is suitably positioned outside of oil as well, and that's going to be a huge asset in the coming times.
All right, let's talk about India for a second. Where are the opportunities there?
India is often given, I'm challenged by my clients saying that the valuation is very high. But if you think about the single biggest market within emerging markets, or rather a single mainstream market where there is a combination of policy coordination, political stability, and reform momentum picking speed, ultimately driving capex growth as well as domestic investors showing up, India is definitely that market. And that's going to be a huge receptacle, especially to Paul's previous point that where's capital ultimately going to go between these 26 countries. So India has many opportunities. The particular areas of interest for us within India are digital consumption, fintech, as some of the banks are reinventing themselves into very, very solid fintech players. Those are two. But the most important and interesting opportunity in India is the industrial sector. It's not the most traditional when it comes to calling it exciting, but there is a very interesting theme around deconglomeration playing out, where value creation is happening as some of these old legacy family-owned enterprises are splitting up into value-creating units.
So if I'm an EM investor, I'm thinking about India, I have to ask the question, what is their COVID policy? Because in China, that's not working for investors. This shutdown every 15 minutes isn't really working for investors, certainly. How about in India?
Now, that's a very good question. If you think about it, one of the biggest things that we like about India at the moment is its geostrategic and geopolitical alignment with the West. And India's COVID policy is a great example of that. It's no different from what the policy in the UK is or the US is. In a way, they've really made testing available to a lot of people. There is data, but they're going about business as usual. And things are kind of just happening in India like they're happening here.
Just real quick, are funds flowing into emerging markets? What are investors doing here today?
So funds are not necessarily just flowing into emerging markets at any rapid clip, but we are seeing some stability as it relates to fund flow within emerging markets. Now, within emerging markets, we see movement of funds into Latin America. ASEAN, we're just beginning to see some traction. Some of the largest funds, as we have talked about in our note, are beginning to see ASEAN differently.
Amazing conversation. So
Thank
fun.
you.
Thank you so much. Really appreciate it. Bloomberg Intelligence strategist Gaurav Patankar.
Coming up on the program, the verdict on Tesla and its ESG credentials.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele, by the way.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
All right, let's talk ESG. We seem to talk a lot about ESG. It is a growing topic on Wall Street, and Tesla is one stock that many ESG funds own. But is that ESG classification really accurate? Here to answer that question is Bloomberg Intelligence ESG strategist Shaheen Contractor. Shaheen, if Tesla's not ESG, I don't know what is. They're electric cars. Talk to us about some of the controversy about Tesla and whether it is an ESG company.
Sure, Paul. So I have to say Tesla is so debatable. So, while Tesla does fit this environmental theme, this impact theme, it does have challenges on the S and the G. And that's where
social and
governance.
Okay.
Correct, social and governance. And that's where we think its inclusion in ESG funds might not be appropriate. And that's why we think it's actually removed from the S&P, and we think that might have been long overdue.
So just summarize for us.
Sure.
S&P.
Yes.
ESG index?
ESG index.
They removed Tesla. Really?
Yes. So they did. So they cited things like poor working conditions, racial discrimination. And I think people often conflate impact with ESG.
Okay.
And Eric Balchunas actually said this really well last week. He said, a company's products don't make you ESG.
Okay.
And I think that's very true.
So can you define the difference between impact and ESG?
Sure. So impact is creating some kind of additionality, like an impact in the world. I see ESG as risk mitigation. It's a company managing ES and G risks within its operating boundaries to avoid unforeseen financial conditions. So it's I view it as impact is the impact of your business on the world, and ESG is the impact of the world on your business. It's kind of...
Interesting. All right.
Yeah.
So did Mr. Elon Musk have a response to S&P's
He was
action?
probably snarky.
Snarky? you
Yeah,
think?
I'm just putting it
He
out there.
did. I won't go into the exact words, but he clearly wasn't pleased.
All right.
But so then, do we need to break out the E, the S, and the G a little bit differently now for certain companies?
So I think it's more important to separate the impact versus the ESG. If you think about ESG as a risk mitigation view, then no, non-financial indicators are all E, S, and G. So not necessarily, but I do think people need to understand the difference between E, S, and G and not think that one makes up for the other, right?
So environmental, social, governance, when you talk to funds, do they place different values on those three components, or is there some consistency out there?
So There's no consistency. Everyone has a different opinion. The way I like to see it is one should understand materiality specific to the company. So if the E is more material, that's what you should look at. S, that's
so
what you should look at.
So if I'm a coal company, the E is pretty important here. Okay.
Yeah.
If I owned the S&P ESG index, now Tesla's out of it, does that mean anything for me?
Not to a large extent. So Tesla, at the end of the day, it is still in many funds. It is in all the MSCI ESG indices. So its removal from the S&P likely doesn't have much of an impact. But what it does do is it just fuels this debate, right? What is and what isn't.
It doesn't like feel very good when you're like, Tesla's not in the ESG.
Yeah, exactly. The whole reason I got this silly car is so I could stop polluting the country. Okay, so what are the companies that are out there that are kind of debatable that people would be aware of? I mean, Tesla's a big one, but the people look at McDonald's and say, okay, they may be doing really well on social and governance, but is it good for your health and all that kind of thing?
So there are quite a few. I think one that comes to mind is Amazon, for example. Another that comes to mind is Apple. Many people think, Apple is an ESG darling, but then it has supply chain issues. So there are a few, especially if the big tech companies fall within this bucket.
Well, to that point, I wonder, where are we in terms of getting better guidelines as to what makes something ESG? Earlier this week, this is obviously unrelated to what you cover, but DWS's headquarters were raided because of allegations of greenwashing. Now, okay, in essence, that's fraud, right? But it also is just really hard to understand what ESG actually means. And I wonder if we're getting any closer to helpful guidelines.
I agree. I think so. There are some regulatory initiatives that I think will help us at least get a little closer there. In Europe, you have things like the SFDR, which has a whole classification around, funds. Actually, maybe last week, or I might be off on days, but the SEC announced guidelines around ESG funds disclosure requirements. So we'll see how that plays out. But I do think it's a step in the right direction.
One of the big challenges I've always felt, and what I've heard more importantly from investors, is data. The quantity and quality of ESG data is just not out there. It's just not really available. Like if I want to do financial analysis, I can go on get my income statements, my balance sheets, my cash flow statements. But when I want to do ESG analysis, where do I go for data? Now, I know on the Bloomberg terminal, we have great ESG data on the FA function, which is a financial analysis function. And just like you can click on the tab for balance sheet or income statement, you can click on the tab for ESG. But I know that's a challenge, isn't it?
Yes. So, Paul, you're right. That's exactly where you go to find the ESG data, at least on the Bloomberg terminal. But no, so ESG data is not as good as financial data. It's not. It's still evolving. It's evolving over time. It will continue to evolve as, regulators step in. But it is a challenge.
And there's not what's ESG for a Fidelity fund manager or may be different from a fund manager.
What their definition is of it is going to be a little different in how they quantify it.
Yeah, versus somebody at, Wellington funds or something.
Yeah. So back to your point on is Tesla ESG or not, I think everybody's opinion is different. Our opinion is it comes back to materiality. What are the material ESG risks a company faces, and is it managing it?
So give us an example of a company that would be an impact investment rather than an ESG investment.
Tesla.
Oh, okay.
Tesla.
Like what we were just talking about for the last 10 minutes?
So that's where Tesla would be a good, an environmental or an impact theme, right? It creates an additionality
the world, basically.
But is it managing its risks and opportunities within its regulatory or operating environment?
All right.
It's essentially debatable.
All right. I'm a tad ESG hesitant or skeptic here a little bit.
No.
Although
really?
I have been... Yeah,
You've been coming around the last couple of years.
I've been coming around the last couple of years. But I look at everything's okay when the markets are going up. But in 2022, we've got double-digit declines in equity indices. We've got double-digit total returns in a lot of the fixed income, like corporate bond. I lost 12% of my total return this year. How's ESG performing in that environment?
So ESG has been challenged, right? If you think of sector allocations, it's overweight tech, it's underweight energy, and that's not worked so far. That's not worked so well this year. So ESG funds have not seen great performance so far this year.
All right, good stuff. Shaheen, Contractor, she's Bloomberg Intelligence strategist, covers all things ESG. We appreciate you being on the show.
Well, coming up on the program, how business could be getting even bigger for eBay.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele. It is 25 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
All right, coming up on the show, let's talk about eBay. It's the online shopping site and has a rising take rate. I'm going to talk about what that means, plus some new features, too. All that could lead to more revenue. For more, we're joined by Bloomberg Senior Analyst for U.S. Retailing, Poonam Goyal. Poonam, all right, school me a little bit here. What's a take rate?
A take rate is the percentage of revenue that a marketplace makes when you sell a product there. So if you're selling a $100 watch on eBay, eBay will take, as of right now, $12 on that sale. That is their current take rate, 12%.
All right, how is that take rate? That sounds like a nice deal, by the way.
Yeah, that's pretty good for eBay.
Yeah, that's pretty good for eBay. How's that been trending historically, and kind of why do you see some upside potentially to that number?
Yeah, so eBay's take rate historically has been closer to 9%, so under 10% for a long time. Quite honestly, even since its inception, it's been under 10%. In the past few years, you've seen take rate rise from 9 to 12%, and the primary driver of that is the payment integration that they have just completed. If you shopped on eBay 2 or 3 years ago, you probably only were able to shop using PayPal. Today, you can shop on eBay using Visa, MasterCard, Amex, any payment type that you would like. And that's added a few hundred basis points.
Can that continue in that? I thought that everyone stopped using eBay and Etsy and stuff now that the pandemic is quote unquote over.
No, I don't think people have stopped using these platforms because they do still offer value and treasure hunt finds, right, that you can't just get anywhere. So these are not places that you go to like Amazon where you're looking for an iPhone charger or you're looking for, a bag of chips. Like, that's not what these platforms are for. They're really for unique things that you can't find anywhere else and that have value to them, especially on eBay, right, because it's resale. So it's things that you want but maybe can't afford at full price, or things that existed a long time ago and now they don't sell on the marketplace anymore really anywhere else.
It is crazy what people buy on eBay. A buddy of mine just bought a boat. I mean, I'm
talking
bought
a boat?
A big boat. So he flew down to Florida and he's like cruising back up to the Jersey Shore, supposed to meet him this weekend. He bought a boat.
Did he test the boat?
No.
What?
It's crazy what these people do. But they love it, and they swear that's where they get the deals. All right, so Poonam, the take rate here, how does it compare for eBay versus maybe some other competing platforms?
It's actually lower. So if you compare eBay to, let's say, a Poshmark's take rate is in the high teens, and RealReal's is in way over 25%. So eBay's take rate has historically been lower than other marketplaces that have come up really in the last decade to take share away in the resale market.
Interesting. I didn't know that about RealReal. And I'm personal. I sell on it, so I want to know that information. What are some of the other features that eBay is adding that could also help juice their revenue?
Sure. So in addition to just further expansion of their payments network, I think what they're also investing in is advertising. Advertising traditionally has not been a source of revenue, but with eBay adding promoted listings, with them featuring these listings on top and outside, they're able to generate more click per ad revenue, and I think that's going to also help the take rate. And then the other thing is, when you buy this boat that, Paul, you were talking about, or when you buy a $100,000 watch, you don't know who you're buying it from. So how do you know if it's real or not?
You don't.
So eBay has a program that it recently launched, which authenticates some of the goods that are sold on its platform. Now, they don't charge their sellers a fee to do this. This is to prove that they have credibility. But they recently, so if you bought $100 sneaker, $100 plus sneaker, they authenticate it for free. But let's say you wanted to sell a $50 sneaker and you wanted to still show that it was authentic. You as a seller now could tell eBay, hey, you have the platform, authenticate it, and pay them a small fee for that.
How has business for eBay been? Because I know it's always been a challenge establishing its identity in the retail e-commerce space vis-a-vis Amazon. How have they done over the last few years? And I guess that goes to kind of how they performed in the pandemic.
Yeah, so the last 4 years have been really about investing in the business and resetting the base. So this year, their revenues are expected to fall in the mid-single-digit range, but then begin to climb next year. And part of that decline that you're going to see is an intentional shift towards getting rid of low-value buyers and really focusing on the high-value buyers, that generate more than half of the GMV on their platform.
What kind of stickiness do we see from sellers and buyers there?
There's they do have a high stickiness rate. I mean, if you think about,
I guess if you get one boat there and you like it, you're going to go to the next one and get it the same place.
You may not get another boat, but you could get something else, right? Because now you know that you can find these unique type of things on eBay, so you can cross-sell that customer into other categories.
Really interesting conversation. Thank you so much. And I truly didn't know you could buy a boat on eBay. Shows you how much I know.
All right, coming up on the program, staking with the boat theme, the cruise industry looks for a return to normal.
All right, you're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Thanks, everyone, for joining us today. Let's stay with the boat theme and talk cruises, specifically a push into the bond market for some of the big-name cruise companies. Joining us now, Bloomberg Intelligence senior credit analyst Jody Lurie. Jody, it's all about reopening still. It's all about traveling. It's vacation packages. It's going to be good for the cruise line guys. What are they doing in the debt market right now?
Sure, Alex. So I think what we're seeing is a continuation of 2021. And by that I mean is that these companies are at the precipice of getting back to normal, but aren't quite there yet. Whereas a lot of companies in leisure and lodging are really already feeling the normalcy going into 2022 summer season. The cruise lines still don't necessarily have all ships in the water, depending on the cruise, and are not generating positive free cash flow yet. So we're seeing these companies tap the debt market still, trying to fill these cash gaps, address their balance sheet, and just figure out ways to survive this next year so that in 2023 they can feel more normal.
All right. So it's interesting here. I remember at the beginning of the pandemic, when the world shut down, the cruise companies were one of the first companies to really come to the market and raise capital because, boy, they knew that they were going to have, really, really strong balance sheets with lots of liquidity. That was a good move. The strategy here is just kind of hang on as we kind of reopen. Are certain companies doing better than others?
So, Paul, it's a little bit more complex than that. I think, first of all, the cruise lines were among companies to figure out ways to shore up liquidity at the beginning, as you stated. But if you think about it, the hotel companies, for example, tapped their revolvers. So they were flush with cash in another way. The cruise lines didn't necessarily have that same flexibility because they were dealing with the fact that they had this moratorium that was imposed on them by the CDC. So they weren't allowed to operate, whereas the hotels just weren't operating in normal settings. Now, the cruise lines, what was interesting about them is they all came to market in spring of 2020 to just build up their cash balances, which is a very smart move, but paid up to do so. And while 2021 was a very great year for them in order to refinance it and bring down their interest expense on a lot of the debt that they paid up for, we're starting to see that at least as interest rates rise this year and as the high yield market isn't as favorable as it once was, they might have to pay up again in order to keep that cash balance high while they address the large debt maturities that they have.
What kind of yields are they looking at right now?
So for Carnival, they just issued a senior unsecured bond in May, and it was 10.5% going out to 2030. which if you compare that to what they did in October, which in October they issued a senior unsecured expiring in 2029, and that one is only 6%. So you see the very big difference in the jump in yield between October and May, and that is really more so a function of market environment than it is a function of the actual individual company itself, in my opinion. These companies are still on track to do what they said they were going to do, which is get all ships in the water by the summer. They're showing that their advanced bookings are growing. They're showing that they're starting to return to normal. They have their eye on reducing the balance sheet starting 2023, meaning bringing down the debt load organically. But they need the cooperation of the capital markets in order to do so. And that cooperation might not be as prevalent as it once was.
Interesting. And you mentioned a lot of that some of those issues were unsecured. Why did they do that? Why wouldn't they go secured using their ships as collateral? Or maybe they're already used
collateral.
up as collateral.
Well, actually, they removed a lot of the what you would call encumbering of the balance sheet over the past year. So in 2020, when they issued debt, and funny enough, Carnival issued debt of similar coupons in 2020, but it was secured debt.
Okay.
And so if you're issuing secured debt traditionally, secured debt has a lower coupon than unsecured debt. So imagine if they had issued unsecured debt back in 2020, it would have been 15, 16% if they could have gotten it. Now, they don't want to necessarily issue secured debt if they don't have to, because that provides them another lifeline if things get uncomfortable once again, whether we enter a recession, consumers start really feeling the effects of inflation and aren't taking vacations like they were or are planning to right now. And so I think the cruise lines are trying to keep every option open that they have available to them as much as possible. So senior unsecured is a better way to go as long as the markets are open to allowing them to issue. But I do think it was interesting to see Carnival issue when you had Royal Caribbean and Norwegian issue in January and February this year, and the climate just completely changed between the Fed conversation, between Russia and Ukraine. I mean, there's all these factors that just shifted the market environment between January and February and May.
Really interesting stuff. 10%. Man, that's back. Okay. Jody, thanks a lot. Jody Lurie, a Bloomberg Intelligence senior credit analyst. All right, let's shift our attention now to energy and Russia, because as the war between Russia and Ukraine rages on, you get LNG shipping rates remain very strong. So for more on that, we want to welcome Bloomberg Intelligence analyst Talon Custer. Give us a sense. What kind of shipping rates are we talking about for LNG?
Yeah, we've seen a recent climb. There's increased interest in term chartering. You have energy security needs. And in addition to that, there's a lot of uncertainty. So these importers are looking to lock up shipping capacity, get vessels to bring the gas for their summer needs and also cover the winter. So we're seeing a lot of, the spot rates are rising, but also the one-year term charter rates as well.
And I mean, let's talk about this. This demand situation seems like really robust. I mean, there's that shortage of energy, and we saw, 6 months ago in England where they really had some natural gas issues. Is there enough shipping to meet this demand?
There is enough shipping. It's pretty well balanced this year, and one thing that's helped out with that is with shipping. Last year a lot of U.S. cargoes were going to Asia, and those longer voyages tie ships up for longer and tightens capacity. But the shorter voyages to Europe loosen that up a little bit. So I think that's helped. But it's pretty well balanced this year.
Where are the most intense shipping routes? Like, where are the most expensive routes? Where are the ones that are easier to get to? What's the most populated?
They do it by day. I mean, the benchmark we go by is just dollars per day. So it's a matter of how, like I mentioned before, how long the voyages are. So a voyage from the U.S. to China, for example, or U.S. to Japan, it takes about twice as long to get there as to Europe. And there's different routes as well, right? So if you go through the Panama Canal, you'll get to Asia quicker as opposed to going around the Cape of Good Hope.
Well, who goes around the Cape of Good Hope these days? That's why we made the Panama Canal, right?
I know it's all backed up now.
Yeah, there's only so many slots. And of the limited slots in a given day, only a couple are allocated to LNG carriers. So like last year, for example, when demand was robust to go to Asia, a lot more ships had to go around the Cape of Good Hope and Suez Canal.
All right, so if I'm a refiner, or if I'm down in liquid natural gas player down in Louisiana or Texas, all my stuff's going to Europe now, isn't it?
For the most part, yeah. Last time I checked, it's roughly 3/4 of U.S. LNG is going to Europe.
Can we do more? Can we do more LNG to meet demand?
They're pretty maxed out at the moment. But I think one thing we've seen with Russia's invasion is that it's expedited investment in infrastructure on the import side, and we've seen a lot more long-term contracts signed, which you need to get the financing to get more liquefaction projects. But they're pretty maxed out now, but we're seeing, we saw a recent FID, and it takes, about 4 years to get a project going. So we'll see more, in the coming years.
And the long-term contract is important because for a while they were going shorter term, like they were doing spots rather than long. So like there's so much natural gas, I don't need to do long-term contracts, and that shift is quite significant. In terms of where the biggest holdup is, in terms of getting more supply out and shipping around, is it export facilities? Is it reliquefaction facilities? Is it actual vessels? Is it actual natural gas supply? Do you have a read on that?
Yeah, it's on the liquefaction side. So I would suspect that LNG demand would be even higher if there was enough supply. Supply is essentially a constraint, and we'll see that more even next year. The trade growth is going to slow because there's just not that many liquefaction projects coming online. And even over the next couple of years, Russia, their Arctic 2, Baltic LNG, those are projects that were going to make up a significant amount of the LNG that was going to hit the market. And now there's a lot of uncertainty surrounding those projects.
What's up next for LNG? I mean, I think that right now it's as good as it gets, isn't it?
For the exporters, yes. You have long-term contracts that get a solid margin, and then for those trading on the spot market, the netbacks are outstanding for them. But on the import side, especially for Europe, that has been buying a lot of the spot cargoes, they are the prices are exorbitant.
Strugs.
Probably unsustainable in the long term.
Yeah. And they have to also build more transportation and pipelines, etc. Really great stuff. Thank you so much, Talon Custer, Bloomberg Intelligence analyst, joining us.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.